Hello traders, Gary Wagner here just after 2 o'clock in Honolulu, 8 o'clock in New York. It is Tuesday, March 31st, 2020, and this is the Daily Report for Gold and Silver. First, an apology. We were having technical difficulties with our recording system today, which is why we are coming out a little bit late. Again, my apologies. The markets themselves were volatile, and they were volatile for the second day in a row, especially gold, which sold off in double digits yesterday and is now adding to that by about $5. We've got, with the exception of spot gold, the entire precious metals complex down, and we also had equities trading lower on the day with a fairly neutral U.S. dollar. Let's take a look at our price board, and from there, we'll look at our technical studies. Traders, as you can see, we're looking at gold futures. We are now looking at the June contract as the continuous contract, down 530 at 1591.20, and that is in the Australian session, what I call the afternoon session. We had double-digit declines earlier today as it traded in New York. Platinum also trading lower on the day at 718. Palladium down almost 3%, $67 at 22.37. And then silver about down 0.25% at 14.12. Lastly, I do want to take a look at the dollar because the dollar is not down very much at all, so it has almost a neutral effect on the other markets. Let's take a look at our technical studies. There is no doubt there was some strong selling pressure in the gold pits today as market participants took that market lower, considering that it opened roughly at 1643 and then closed right around 1591. That was a significant move. It was significant in that we had the tail, the lower wick, actually go into the 50-day moving average. And that's something that, to me, signals that we are not in a short-term bullish trend. However, we're certainly above the 100 and 200. The other thing is when we look at where the lows came in Australia, you get them coming in right at around 1578. That is the 50% retracement. Now, absolute tops and bottoms are a little bit easier to call, but there's a tremendously wide spread between them because you've got these tweezer tops right here. That refers to these two candles. Let me get my proper circle, but that refers to these two candles right here. You've had a couple of attempts to take out 1700, and then when we look at the bottom, we definitely have what's called a tower bottom, simply where you get multiple candlesticks that have lows that are approximately in the same area. So where do we think this market could go to? Well, if it does not hold the 50%, then what we really are going to need to look at the next level below it, which of course is the 61.8% Fibonacci retracement. Underneath that comes a 78%. But for right now, I want to concentrate on the 61.8 because my sense is that if we do see the market slide a little bit more, one of the more logical places to look for some support comes in at the 0.618% retracement. That is a key number to the Fibonacci number sequence because the relationship between each number and its component number, the next number, is a sum of the current one as well as the last number that came just prior to that. So I would look for 1550 as a possible entry point, but again, we need technical confirmation and certainly are not getting that. You can almost say that this is hammer-like, but the tail's not long enough, and it opened and closed below the 50-day moving average. It is for that reason that I am recommending that we maintain our neutral stance with no active trades in gold or silver. And traders, The last chart I want to look at on today's show is the continuous contract, although each candle represents 1 week in time. So we actually have slowed it down in a bit, and we typically don't want to have these moving averages up when we do the conversion, because they are really set up to work off of a daily chart. So what we can see is this. Back between, call it July and October, this would be of 2018, we definitely saw this market hit a bottom. It wasn't the worst we have seen, but it was certainly the lowest the market had traded to since about, call it 2016 and 17. And then, of course, you would have to go back to 2015. We'll try to pull that up for you. And that way, we can see where that low really came in at. And what I'm referring to is this particular area right here. Let me get a highlighter. And that would be these lows here. That really, to me, was the conclusion of this very, very long and protracted sell-off. Because once we hit this area, the market began to slowly and methodically move back up. But what we've seen recently has been a little bit more wild, because if you take a look at the highs and lows, we can certainly say that we have an extended range in a much more volatile market. And I'm referring to these last weeks in trading. Low at 1451, high at 1704. So we're talking about a pretty sizable move, a $250 spread between those areas. Now, currently, absolutely have support at resistance at 1704. And then we have our support sitting at 1451. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.